from a stock that's done okay with high expectations by Josh to one that's done really poorly that you've sold, Brian Belski. It's down 50% year to date, thereabouts, and it is Deckers. So tell me why you're bouncing on this now. Is it just simply it's been so disappointing you can't stand to hold it anymore?
That's part of it. The other part of it is that we think there's another alternative in the space that we like a lot better, and that's ON, that we've owned for 3 years. But going back to Deckers, we took a fly on it in April, right around the same levels. Stock sold off, and now it's bounced. We thought, you know what, let's get out now that we're flat, admit that there's going to be a lot more operationally that we think it needs to go on there. So from a fundamental perspective, in terms of momentum, fundamentally, we like ON a lot better.
I mean, is this in any way a consumer statement? Because you're trimming Target as well, which has been another dismal performer, down more than 30% year to date. Are these just idiosyncratic things you're done with? You still think the consumer's in reasonable shape?
We do. I think the two things are mutually exclusive to each other. You know, Target we still think has operational issues longer term. We have now limited Target to our value portfolio and our dividend portfolio.
Deep value.
Deeper value.
Deep value.
And we think that stock from a longer term perspective, meaning the next 3 to 5 years, looks very, very interesting. We still like in that space Walmart and Costco a heck of a lot more, Scott. This is not an indictment on the consumer selling Deckers or really limiting Target. It's more about being very, very idiosyncratic in terms of our stock picks.
Yeah, I mean, I think the consumer is just confounding people. And, you know, on one moment looks really strong, and then you think everything's going to be good. Then there's a Gallup poll out today that Americans expect to dial back holiday spending significantly this year. That's according to the poll. Now, Stephanie Link has been as aggressive and bullish, I think, as it relates to the consumer, unwavering in your belief that consumers are doing well, that they're going to hang in there, and that they're going to crush it this holiday season. I mean, you've said pretty much all of that.
Well, the National Retail Federation is the one that said that people are going to spend $1 trillion on holiday spend this year. On average, a family is going to spend $900 per family.
I know. What does that mean, though, relative? Okay, that's what I was going to ask you.
The best in 23 years. That's number one. Number two, we talk about the labor market all the time. I know everyone wants to talk about ADP and non-farm payrolls. I look at weekly jobless claims. We just had the lowest weekly jobless claims since September of 2022. I mean, that's a big statement. The JOLTS numbers were better. So consumer has jobs. They have better wages. Wages are running 4.5%. We are a nation of spenders. You have to have the right product, though.
Well,
you have to. Yes, we are.
No, we are. But the reason I bring it up and pivot to you is not so much so you have to defend your position on the consumer. It's because you're buying more Capital One because of your belief in the consumer.
In the consumer, that's right.
Right?
Well, absolutely.
So that in and of itself is the defense.
But I think it's important to talk about why I have been bullish on the consumer. And I think in my 33 years of doing this, it's always been a bad bet to bet against the consumer. And again, if it's the top end that's doing all the spending, all right, but they're doing the spending. And if you have the right products, they will buy them. So Capital One, it's the cheapest financial stock that I have in my portfolio, trading at 11.8 times earnings, 1.3 times book value. I think the 2026 story sets up very well from the Discover transaction, $1.6 billion in synergies. They are going to see better profitability. Net interest margins are poised to go higher. Capital return, they have 300 million and 300 basis points more in excess capital. So they're going to buy back $16 billion worth of their stock. So I like that setup, and I think the numbers go much higher.
Okay, so you've heard the other members of the committee, and I appreciate you being patient while we got through those moves because they're important to do. Yep. And now you get to, as a committee member, judge the moves that you just heard about. Anything stand out to you, either like or hate?
Well, I think overall what we're hearing is that each of the three members are going in a different direction than what we've heard about over the last 18 months, which is technology, technology, technology. And I think that's representative of where we are in the market as we move towards the end of 2025. The broadening is real. I believe the Russell 2000 has recorded a new all-time intraday high today as we speak. I love the financial sector. If you look at S&P 500 highs today, there are 15 of them as we came on the show, and 9 of them are in the financial sector, whether it's your Truist, your Citizens Financial Group, Morgan Stanley, Goldman Sachs. So the financials are represented by really strong tailwinds. I think the regulatory relief is helping there. As far as consumer discretionary, look, we'll talk a bunch of consumer discretionary stocks later in the show, but for us, it's been about having the idiosyncratic story. Ulta Beauty is an example of that. Okay, they have embraced a younger generation. It was reflected in their earnings report recently. It's about the off-price with TJX and Ross Store. So I think the totality of it and the message from it is it's a healthier market because there's more places that you can go for opportunities represented by what we heard from Josh, Brian, and Steph.
I was going to do this later, but segues, I think, well here in terms of financial moves that you've made several.
Yeah.
You bought more J.P. Morgan, correct? You bought more Wells Fargo, which is, if not the largest, it's one of Steph's largest positions. Why buy more here? These stocks have had a pretty good move. J.P. Morgan maybe not as great lately as some of the others, but as a group, they've performed really well this year.
Yeah, if we take a look at the performance of our portfolios and specifically how financials we've gotten the sector right. Now we need to get more concentrated in some of the stocks. That's why we lessened some names like Progressive and Citigroup and added more to Wells Fargo in particular because we think there's a lot of fundamental momentum there. In the small mid-cap space, we love small mid-cap financials. They're fantastically positioned in terms of the Glacier Bank Corps and the Stifels and the Ray J's.
Well, you don't love Huntington Bank shares that much.
Huntington Bank shares, yeah.
Doesn't that fall into that category?
It does, but Huntington Bank shares has been a roll-up of a lot of different assets, and they've been very aggressive in terms of how they've been building that out. We like more the organic growers within the very small banks. I think that the theme going forward is going to be the really big banks and the really small banks. In between, I think it's going to have more trouble. That's why we sold PNC as well.